Hello, good morning, good evening, good midnight, wherever you are, whatever time it is. Hope you're having a great whatever. My name is Soren. Welcome back to my channel. And today I'm going to be talking about investing in the system. So this is about basically investing in banks and insurance and how that is different from investing in companies that sell products and other things like that. And this also can be looked at a little bit like kind of similarly to companies like Netflix, where they have subscriptions coming in consistently. The insurance is pretty similar to that. Banking's a little different. That has a whole idea of its own, but I decided to throw them together because they're not long enough for their own videos, really. So here we go. So basically, I'll start off with just the numbers for both of them. So my last video, which I recommend watching just to get basic ideas of numbers, one of them I said price to equity. It's actually price to earnings, and or PE ratio. And so you don't actually use that for when you're investing in either banks or insurance. And usually you should actually use price cash flow is usually a better idea of that. But what you really should be looking at with banks and insurance is price to book, because that will just give you a better idea of all these things. And then for all those, the numbers are the same for the parameters, but just looking for different numbers. Cash flow can work for insurance, but banks you want price to book because it has its own system. So I'll just do a quick crash course on how banks basically make money, or at least part of how they do. So basically banks have money and they lend out that money at a interest rate, so that if, let's say, you borrowed $1,000, then they'd be giving you back, or you'd be giving them back $1,100, and then they just made $100. That's a very small scale scheme, not using any actual numbers, but basically that gives you the idea of what they're trying to do here. And then insurance, as I'm sure most people either understand or if they watch the videos, they have. But basically, that whole idea is that you are giving people money, like on a subscription almost, over time. And then let's say you give a couple $100 a month, and then that adds up. And it might be, and then you may crash your car. And then insurance will pay for repairing that, and because you've been paying the money overall. So if people don't get in car crashes, then they reward you and might give you a better rate. So then there are things like that so they don't have to pay money, and they actually end up making money off of that, but it makes it also a better deal for you. So it's a win-win scenario. So now that we've got basically banking and insurance figured out, and we've got basic numbers, now I'm going to talk about some of the other things, which this next one is pretty rough. You might have guessed it. You don't value ROE or ROIC nearly as much. Yep, I can see you crying through the camera. It's really sad because all of us love it because we get to see the return. Everyone likes return, making money, but that is one of the things that we don't judge it on. So this you want to judge on price to book for banking, price to cash flow, or price to book for insurance. And then you can use dividends. Usually banks have lower dividends. That's not always true. I always go with like a you do you motto for banks, and that's just kind of how I go around with things. As a young person, I don't really need dividends. I do invest in some 6 and maybe 7% dividend stocks. I think 6.55 is my highest, which is pretty good. That's actually really good for a lot of companies, but I don't like to weight it too much because you can find bad companies that pay out a good dividend, and that that just shows signs of financial weakness. So just looking at debt, looking at all these other things is very important. Also, banks shouldn't have too much debt because they are banks. So they're supposed to be the ones having the money and giving it out. Also, when you're thinking about banking, think about it backwards from how you think about banks. So when you take out money, that's a liability for you because you need to pay that money back. Otherwise, banks will take away things from you, or you'll basically bankrupt or something like that. In any case, it would be bad. So it's a liability for you. But when banks loan out money, that's an asset for them. And when they just have it laying around, that's a liability for them because it's not making them money, and they need to make money to be able to sustain themselves. So whenever you're thinking at it from the bank's point of view, think about it as the opposite of what you do. So loans, good loans, not default, not ones that'll default, but good loans are liabilities for you, but they are assets for the bank, and then vice versa. When you're thinking about money in the bank, money in your bank account is an asset for you, but is a liability for the bank. I'd recommend not having very much savings accounts. I think are good, but not that important. You shouldn't have that much in either savings or a checking account because you should be trying to save money so that you can invest it for long term and live off of the least amount as possible. If you want to learn some great tips on doing that, go over to Grant Stefan's channel. And if you're not already subscribed there already. Also, if you're a young person who is interested in learning about investing, comment down below, and I'm trying to find young people to give like master classes on starting investing young. If you just want to see that on the channel, also comment down below. Any other video suggestions, please do that. As I said at the beginning, this is a shorter video, so yeah, but basically I'm just going to sum up everything that I've said. So you don't use price to earnings for banks or insurance. You use price to cash flow if you want to for insurance, but price to book's more accurate, and price to book is the way to go for banks. Also, when you're thinking about the banking model, think about it backwards from how you think about it. And for insurance, the same, but insurance a little bit easier to understand, I think, in a lot of ways. Also, there are a lot of other successful businesses that start out with insurance and grow into other things. These are companies like Berkshire Hathaway. It's a great example. Big, great company that made a lot of people a lot of money and still is. And so just look out for companies like that because usually they're pretty low risk and as well as banks because they're the ones who would have to insure it. They're not other companies that don't really have as many responsibilities or take on very much debt because they are either the ones who lend out debt or they're the ones who in unfortunate scenarios are the ones who have to bail them out. So they usually stay away from risk, and that's always a good thing to look for. So thank you for watching. My Twitter will be linked down below. It's also in my channel. Please subscribe if you like this video. All of this is just YouTube nonsense, but like the video if you liked it because it really helps with the YouTube algorithm get my channel to get more than 14 views on my last video. And yeah, just share it with a friend to help grow the channel, and as a meme, as a hopefully advice. So thank you, and have a great rest of your evening, day, night, whatever.